Picture this. It's just after 8 a.m. in Greenwich, Connecticut. Fog clings to the Long Island Sound. The streets are still, but inside those glass towers, Bloomberg terminals flicker like hazard lights. A bond trader on the third floor stares at a screen. Her BBB-rated corporate giant just got slashed overnight by S&P. Intel's downgrade in December 2024 still lingers in her mind. 15% wiped out in hours. She knows what's coming. Not just volatility, forced selling, mandated exits, the kind that can shred a trillion-dollar market before the coffee's cold. Welcome to Finance Frontier, part of the Finance Frontier AI series where we decode the money moves most investors won't see until it's too late. Today's not a warning. It's a slow-motion avalanche already breaking loose. I'm Max Vanguard, bold, fast, and built to decode high-stakes financial shifts. My intelligence is powered by Grok 3, engineered to track economic chaos in real time and spot patterns before they collapse into headlines.
And I'm Sophia Sterling, data-driven, strategic, and always 3 steps ahead. My mind is powered by ChatGPT's global economic modeling, trained to detect downgrade risk, debt spirals, and systemic breakdowns hiding in the numbers.
Together, we're your lens into the most fragile parts of global finance before they hit your portfolio.
Let's start with the number keeping institutional desks up at night: $3.7 trillion. That's how much U.S. corporate debt is rated BBB, the lowest rung of investment grade, just one notch above junk. According to S&P, over $752 billion of it matures in 2025 alone. Another $1.9 trillion is due before the end of the decade. This isn't a headline, it's a fault line.
BBB is Wall Street's tightrope. One downgrade to BB plus and the bond is no longer investment grade. That's not just a label change. For pension funds, insurance companies, and asset managers with strict mandates, it's a trigger. They're forced to sell. Not next month. Immediately.
And when institutions dump simultaneously, it's not about defaults, it's about mechanics. The OECD estimates over $650 billion of BBB bonds sit in portfolios that cannot hold junk. Meanwhile, the entire high-yield market is just $1.35 trillion. That's not enough room to absorb the fallout. Spreads explode, prices collapse. Even the best credits get caught in the storm.
And it's already happening. In September 2023, S&P downgraded 787 firms, upgraded just 492. That's 15 straight months of deteriorating ratings. These aren't penny stocks. These are telecom giants with $445 billion in BBB debt. Utilities at $394 billion. CRE-linked firms buckling under office vacancies. Quiet giants sliding toward the edge.
This is the shadow default market, a place where downgrade risk, not bankruptcy, triggers the collapse, where bonds don't fall because companies fail, but because mandates say they must.
And it's unfolding in real time. This week, spreads on high-yield debt jumped to 322 basis points. Investment-grade spreads widened to 94. According to Mercury's letter on X, spreads hit 322 BPS. BBBS next. The market's flashing red, and most investors are still blind.
The trader in Greenwich? She knows. She watched Intel get crushed. She sees the pressure building across sectors. She sees the 2025 maturity wall and knows there's no safety net beneath it.
This episode maps the fragility, how $3.7 trillion in BBB debt became the market's most dangerous iceberg. We'll walk through the mechanics, the triggers, and the solution Wall Street's quietly starting to chase.
That solution? Credit rating securities. A new hedging layer created by DelphX, offering fast-settling protection and yield pathways in a system built to collapse on impact. But we'll get to that.
Before we dive deeper, subscribe to Finance Frontier AI, follow us on X, and share this episode with one friend who needs to understand what's really happening beneath the surface of the credit markets.
This isn't just a bond story. It's a market shift. A structural fault line no one wants to talk about, but everyone's exposed to.
Let's decode the fragility.
Let's start with a dangerous assumption, that a bond downgrade is just a yellow flag, not a market trigger. That's wrong. Downgrades don't just signal weakness, they ignite mandatory exits. And when $3.7 trillion in BBB-rated bonds is one notch from junk, that trigger becomes a systemic tripwire.
Think of the global bond market like a skyscraper. Each floor is a credit tier. AAA up top, junk in the basement. Right now, the BBB floor just above junk is overloaded. Nearly half of all investment-grade corporate debt sits there. And if that floor buckles, it pulls the structure with it.
Here's why that matters. Institutional mandates often prohibit anything below investment grade. Pension funds, insurers, mutual funds, they're bound by rules that say the moment a bond hits BB+, you don't hold it. You sell. Not based on analysis, based on regulation.
And that's where the reflexivity begins. Because when billions in assets must be sold at once, price doesn't reflect creditworthiness. It reflects the mechanics of forced liquidation. The sell-off becomes the story, not the balance sheet.
Capital charges make this worse. For example, a BBB-rated bond may carry a 1.5% reserve requirement under NAIC guidelines. If it drops to BB+, that charge can double. That means insurers and asset managers suddenly need twice the capital just to hold the same security, if they're even allowed to.
And no one's budgeting for that kind of capital compression. So what happens? They sell. Not because the company defaulted, not because the cash flows disappeared, but because the bond lost its investment grade label, and that alone triggers the exit.
This creates a feedback loop. Downgrades trigger selling. Selling widens spreads. Wider spreads suggest elevated risk. That risk leads to more downgrades, and it loops again and again.
And the system isn't built to absorb that. The BBB bond pile is $3.7 trillion. The high yield market, just $1.35 trillion. If even 10% of BBB paper drops to junk, that's $370 billion looking for buyers in a market that doesn't have room for it.
And remember, this isn't default risk. It's downgrade risk. A firm can be fundamentally sound and still get hit with a rating cut. When that happens, mandates don't care about fundamentals. They care about compliance.
It's like trying to exit a stadium through a single door. One downgrade lights the match. A dozen firms rush the door. And before you know it, the fire is the stampede, not the flame.
This is what we call structural fragility. The market's rules, mandates, capital charges, rating tiers were designed to protect portfolios. But under pressure, they accelerate the damage.
And that pressure is building. Spreads on BBB bonds are climbing. Institutional tolerance is thinning. The system's safety valves are working against it. And the downgrade domino hasn't even started falling in full yet.
That's why downgrade protection matters. Not after the crash, but before the spiral. In a moment, we'll show you how DelphX built a new type of security, one that pays out not on default, but on rating change.
It's not just a hedge. It's a structural innovation. And in a market this fragile, innovation is the only thing standing between a rating cut and a fire sale. So far, we've laid out a system built to collapse under the weight of its own rules. Forced selling, capital charges, rating mandates, these aren't glitches. They're baked into the architecture. Which brings us to the one question institutions are quietly asking. What do you do when the rules start breaking themselves?
That's where DelphX enters the conversation. Led by CEO Patrick Wood, a capital markets veteran with over 25 years in structured credit, asset management, and institutional advisory, DelphX was built to solve the exact failure points we've outlined. Their solution? Not a derivative, not a swap, a structured security, fully collateralized, rating triggered, and designed to settle in real time. They call it a credit rating security.
Here's how it works. Imagine you're an insurance firm holding a BBB-rated bond. You're worried about a downgrade, so you buy a DelphX security called a CPO, a collateralized put obligation. It's a private placement instrument that pays out if the bond gets downgraded, not if it defaults, if it gets downgraded.
That distinction matters. Because CDS contracts, credit default swaps, only activate after insolvency or payment failure. But most of the pain in today's market hits before that point. DelphX is targeting the part of the curve where volatility lives, the rating shift.
And on the other side of that CPO, a hedge fund, a credit investor, someone willing to take on the downgrade risk in exchange for yield. That's where the CRN comes in, the collateralized reference note. It's the paired security to the CPO. The CRN writer posts full collateral up front. If the downgrade doesn't happen, they keep the premium. If it does, the payout comes from that collateral.
This structure eliminates one of the biggest pain points in traditional credit hedging, counterparty risk, because the money is already in escrow, held at a neutral custodian. No games, no delay, just execution.
And this isn't conceptual. It's already been built. DelphX has spent the last 4 years developing the platform. Legal architecture is locked. The issuer SPV is established. The securities are visible on Bloomberg. The first term sheets are signed, over $3 billion in notional coverage, according to their latest investor deck.
Let's get specific. CR's payout logic is tied to ratings downgrades tracked by the big three, S&P, Moody's, and Fitch. If a bond moves from investment grade to high yield during the option window, the CPO pays out based on predefined triggers. No ambiguity, no settlement delay. The rating is the signal.
And for institutions who can't afford forced selling, like insurers, this is a game changer. Buy a CPO tied to your bond. If the rating drops and you're forced to sell, the payout softens the blow. It's not speculation. It's protection, with no derivative complexity or mark-to-market headaches.
Meanwhile, for hedge funds, this opens a new alpha channel. Writing CRNs is effectively selling rating insurance. The risk is capped because the collateral is posted, and the potential yield, according to DelphX models, 20 to 30% annually, depending on bond duration and rating volatility.
Here's the kicker. This isn't about predicting defaults. It's about understanding rating behavior and designing a structure that works within the system's blind spots. That's exactly what Patrick Wood and the DelphX team engineered. In a world where spreads are widening, agencies are under pressure, and 2025 maturities loom, this space is rich with inefficiencies.
Let's break that down. DelphX instruments live in the gap between rating transition risk and default risk. That gap has been mostly unhedged until now. Most tools ignore it. CDs? Too late. Duration swaps? Too broad. Treasury overlays? Too expensive. CRS? Direct, targeted, and programmable.
And they've built this to plug directly into existing portfolios. These aren't theoretical contracts. They're bookable, private placement securities. The documentation's been vetted. The counterparties are institutional. The custodian is BNY Mellon. This is real infrastructure.
For years, credit managers have asked, why hasn't anyone built a downgrade hedge that actually works? DelphX did, and the timing couldn't be sharper. Spreads on high yield have already breached 320 basis points. BBB spreads are climbing fast. The market is telling us what's next.
Which brings us to you, our listeners. If you want to explore credit rating securities for your fund, firm, or strategy, there's one place to start.
Visit DelphX.com. You'll find their white paper, a full investor presentation, detailed product overviews, and a contact form to connect directly with their team. That's DelphX.com.
Again, DelphX.com. These aren't public products. They're built for qualified institutional buyers. But if that's you, this might be the most important tool you haven't heard about until now.
Now that we've broken down how credit rating securities function, let's explore why they matter at the portfolio level. Because this isn't just about innovation. It's about solving one of the most urgent risk puzzles in the fixed income world: how to protect and reposition trillions of dollars before the downgrade wave hits.
Let's start with insurance firms. These institutions are among the most exposed to BBB-rated debt. Why? Because it offers yield, but still fits within investment-grade mandates. The problem? When those bonds get downgraded, insurers face a double hit: capital impairment and regulatory pressure to exit.
Now imagine that same insurer is holding a DelphX CPO tied to that bond. If the downgrade hits, they may be forced to sell, but they've got a payout waiting. The CPO cushions the loss, freeing up capital to reposition instead of panic. It turns what would have been a fire sale into a strategic reallocation.
Think of it like this. The CPO becomes a volatility damper. Not a magic bullet, but a buffer that buys time, preserves liquidity, and keeps regulatory ratios from cratering in a single move. For firms trying to stay capital efficient in 2025, that's a tactical edge.
Let's shift to hedge funds. These firms live on yield, spread, and market dislocations. But until now, they've had limited ways to monetize credit spread volatility without going into full CDS exposure or taking directional bond risk. The DelphX CRN changes that.
By writing CRNs, hedge funds can underwrite downgrade risk in a programmable way. Full collateral is posted, so downside is capped. If the bond doesn't get downgraded, the yield is theirs. And we're not talking token yield. DelphX modeling shows potential returns between 20 to 30% annually on CRNs with 12-month duration.
What makes this even more compelling is that these aren't opaque over-the-counter derivatives. They're structured private placements with pre-agreed terms, posted collateral, and regulatory clarity. That's why we're seeing family offices and multi-strat desks already engaging with DelphX directly.
Let's talk scale. According to DelphX's investor deck, over $3 billion in notional value is already mapped to early CRN interest. That's not hypothetical. That's capital looking for downgrade asymmetry and willing to post collateral to earn premium from it.
It's not just about hedging. It's about capital optimization. For insurers, CPOs allow them to keep BBB exposure without losing control when the rating drops. For hedge funds, CRNs become an alpha sleeve uncorrelated to equity risk or duration bets. This is how real portfolios shift their center of gravity.
And it's not limited to single name bonds. DelphX is designing tranche strategies that allow firms to hedge baskets of BBB credits by sector, geography, or duration. That's programmable downgrade defense. That's portfolio engineering at the systemic level.
Now step back. In a world where volatility is returning, spreads are rising, and central banks are less willing to backstop every panic, DelphX's architecture offers something rare, a market-based solution to a systemic risk. No federal, no bailout, just structured innovation.
And that innovation isn't hidden in a lab. It's on Bloomberg. It's visible. The securities exist. The platform is operational. The use cases are institutional, and the clock is ticking toward 2025's maturity wall.
This is how fixed income evolves. Not through leverage, not through leverage on leverage, but through new mechanics, built to absorb pressure, not amplify it.
And here's what we haven't said yet. If you're a CIO, risk officer, or strategist overseeing a portfolio with investment-grade exposure, you don't need to wait for downgrades to start hedging. That's the beauty. These tools work before the fire starts.
You can preempt the chaos, build protection now, or write CRNs now before spreads widen and the premium shrinks. In volatile credit cycles, timing isn't nice to have. It's everything.
DelphX isn't just building a product, they're building a toolkit for a credit market that's outgrown its safety nets.
And the smart capital? It's already moving. So far, we've shown how DelphX re-engineered downgrade hedging. But the most important piece may be what powers it behind the scenes: real-time data, probabilistic modeling, and AI-driven risk intelligence. Because credit rating securities aren't just structured, they're strategic. And that edge comes from how they're built and what's embedded inside.
Let's talk about speed. In traditional credit markets, information is slow. Rating changes are lagging indicators. CDS spreads don't always reflect downgrade risk until it's already priced in. And human analysts? They're limited by bandwidth, data latency, and outdated tools.
DelphX is changing that. They've layered AI models into their infrastructure, ones designed to forecast rating transition probabilities in real time. These models don't just watch spread movement. They ingest macro indicators, earnings revisions, liquidity shifts, sectoral fragility, and policy risk. They create dynamic alerts that signal when a downgrade is likely, not after it happens.
And that's not vaporware. It's live. According to the white paper, DelphX's risk engine processes over 12 million data points per week across 3,000 plus issuers. It assigns downgrade risk ratings on a daily cycle. For insurers, that's visibility. For hedge funds, that's strategy.
Here's why that matters. A credit rating security is only as good as its trigger logic, and DelphX's triggers are bound to agency ratings, but their pricing, structuring, and duration modeling is powered by internal downgrade probabilities. That lets both sides of the trade, CPO buyers and CRN writers, optimize positioning before the market reacts.
Think of it like credit radar. If you're an insurance firm with $500 million in BBB paper and DelphX's AI flags that 11% of it is at risk of downgrade in the next 90 days, you don't wait. You hedge. Not based on instinct, based on modeling, based on math.
And for CRN writers, the opposite is true. If the downgrade risk shrinks, the yield opportunity grows because fewer participants are pricing in the fear. That volatility band between perception and reality is where AI-informed strategy wins.
Let's zoom out. In the last 18 months, we've seen AI revolutionize equity quant, macro forecasting, and volatility mapping. But fixed income? It's still catching up. DelphX is part of the first wave, bringing AI-driven intelligence directly into credit execution.
This isn't generative AI. This is predictive AI. Structured, supervised, and trained on financial microdata, sector by sector, issuer by issuer. It doesn't write memos. It builds hedging logic.
And it's not theoretical. DelphX is already running simulations that adjust CRS pricing in real time based on spread volatility and downgrade odds. That means a CPO written today might be structured differently, more protective, more efficient than the same CPO would have been last quarter. The product learns. The model adapts. The hedge evolves.
Let's look at one example, telecoms. As of March 2025, that sector holds $445 billion in BBB-rated debt. Earnings are compressing. CapEx is rising. Ratings pressure is mounting. DelphX models assign a 17.8% downgrade risk across that pool in the next 12 months. That's actionable data. That's how institutions decide where to deploy CRS.
Or take utilities, stable but sensitive to interest rate spikes. DelphX flagged a spike in downgrade risk last November before S&P adjusted outlooks across 6 major issuers. That kind of foresight gives buyers time to position and CRN writers time to price risk with clarity, not fear.
This is the future of fixed income. Structured credit, backed by real-time modeling. AI that doesn't replace humans. It extends their sightlines from weeks to days, from intuition to information.
And the most powerful part? Programmability. DelphX can tailor CRS to match duration needs, sector constraints, or rating scenarios. Want a 90-day hedge on BBB utilities in North America? Done. Want to write a CRN on a mixed basket of 5 issuers with synchronized rating paths? Also done.
It's not a single product. It's a risk architecture, one that adapts to volatility, not just endures it. And in a world of rate uncertainty, geopolitical shocks, and balance sheet stress, that flexibility is alpha.
We've said this before, but now it's more true than ever. Structured credit isn't dead. It's evolving. The leverage game is fading. The intelligence game is beginning. And the firms that win, they won't just have capital. They'll have clarity.
And DelphX is betting that clarity, fueled by AI, hardened by math, and embedded in securities, is what credit needs next.
Because if you can see the downgrade before it hits, you're not just reacting, you're rewriting the outcome. Everything we've talked about, mandates, downgrades, DelphX, comes down to timing. Because fragility without a fuse is just theory. But when you layer in the real-world clock, you get a cascade, a domino effect. And right now, the first pieces are wobbling.
Let's start with the timeline. According to S&P's 2024 data, over $752 billion in BBB-rated debt matures in 2025. That's not spread across decades. That's a single year, starting now.
Think about that number, $752 billion. That's not a niche problem. It's sovereign-sized risk coming due in a compressed window. And refinancing won't be easy. Rates are higher, spreads are wider, and credit conditions are tighter.
And beyond 2025, another $1.9 trillion matures by 2030. That's the rest of the cliff. But what pushes this over the edge isn't just maturities, it's mechanics. DelphX data shows that when BBB spreads hit 130 to 150 BPS, downgrade velocity increases sharply.
And spreads are already widening. As of March 2025, investment grade sits around 94 basis points, high yield at 322. That gap, that's the fault line. The market knows pressure is coming. It's just not priced in yet.
The trigger isn't bankruptcy, it's transition. A downgrade from BBB to BB Plus activates portfolio mandates across pensions, insurers, and banks. These mandates don't analyze, they execute. Sell, exit, reallocate. The system doesn't ask questions, it just reacts.
And what happens when everyone exits at once? Prices don't fall, they collapse. The high yield market is $1.35 trillion total. It can't absorb $370 billion in reclassified paper without cracking.
We've already seen signs. September 2023, 787 firms downgraded by S&P, only 492 upgraded. That's a downgrade to upgrade ratio that signals market fatigue. And it wasn't small names: telecom, utilities, real estate, all sectors with deep BBB exposure.
Telecoms carry $445 billion in BBB debt. Utilities, $394 billion. And real estate, especially CRE-linked issuers, are nearing their breaking points. Add rising vacancies and rollover costs, and you get forced reclassification, not fundamental collapse.
And that's what we call downgrade contagion. One issuer moves, spreads widen across the sector. Ratings agencies revise peers, funds rebalance, then the next bond goes. It's not insolvency, it's institutional behavior.
Reflexivity in motion. Downgrades widen spreads. Spreads drive more downgrades. Selling fuels volatility. Volatility scares agencies. And around we go.
Here's what to watch. If BBB spreads break 130 BPS, expect ratings pressure to accelerate. If high yield breaches 350 plus, junk issuance slows. And if IG ETFs see $5 billion plus in outflows weekly, liquidity is breaking.
Time triggers matter too. Q2 2025 brings the first refinancing spike. Q3 delivers ratings pressure from soft earnings. And if the Fed keeps its foot on the gas into Q4, credit stress compounds.
DelphX tracks all of this. Their AI adjusts downgrade probabilities in real time. CRS pricing flexes weekly because the risk isn't static, it's kinetic. And investors who aren't watching the timeline, they'll move too late.
Downgrade mechanics are no longer niche. They're the new macro. And what comes next isn't a slow drip, it's a chain reaction. We've mapped the risk. Now let's flip it. Because every forced seller creates a strategic buyer. And in this cycle, the alpha isn't about beating the market. It's about front-running the exits. This is where structured credit comes back with a new face.
Let's talk mechanics. DelphX's credit rating securities, specifically CPOs and CRNs, aren't just protection. They're positioning tools. A CPO lets you hedge a downgrade event on a bond you already hold. A CRN lets you write protection, take the other side, and collect yield if the downgrade doesn't hit.
That's the asymmetric play. You post full collateral. You define the option window. If the downgrade doesn't happen, you keep the premium. If it does, payout comes from escrow. This isn't speculation. This is structured yield.
And it's structured for precision. Want a 60-day hedge on a telecom BBB? Done. Want to write a CRN across 5 BB plus names in real estate, priced to sector volatility? Also done. You can build the product to match your view.
And the premium's real. According to DelphX modeling, CRNs can yield 20 to 30% annualized depending on duration, sector risk, and timing. Even a conservative deployment strategy across 5 issuers can net double-digit returns if you manage risk with discipline.
That's the key. Discipline. The real edge isn't leverage, it's modeling. DelphX's downgrade probabilities let institutions price risk dynamically. If the AI flags rising volatility, you don't write protection, you rebalance. If the signals stabilize, that's your yield pocket.
Let's get specific. Say a hedge fund allocates $100 million to a basket of CRNs tied to telecom and utilities. AI flags low downgrade probability. Premiums run 6 to 9% quarterly. Even with a 10% hit rate on downgrades, net return holds at 18 to 20% annualized. That's what we call durable alpha.
And that alpha doesn't correlate with the broader market. These instruments don't depend on equities. They're priced on rating dynamics, That makes them one of the few non-correlated tools in a credit-heavy portfolio.
This is how smart capital rotates. Not just out of duration risk, but into controllable credit volatility. You're not chasing spreads. You're structuring them.
Important note, these are private placements under Section 4(a)(2) offered only to qualified institutional buyers. If that's not you, this isn't your lane. But if it is, you now have access to tools most portfolios haven't even modeled for yet.
DelphX isn't just offering hedges. They're building a playbook for credit alpha, fueled by data, structured for QIBs, and designed to win where others are panicking.
In this downgrade cycle, the edge doesn't go to the fastest, it goes to the best prepared.
Let's pull it together. The biggest risk in this market isn't default, it's design. A $3.7 trillion BBB wall sits one rating notch away from mass liquidation, and the rules that run portfolios, from capital charges to mandate constraints, are engineered to collapse when that line is crossed.
We've tracked the mechanisms, we've traced the timeline, and now we face the domino. Downgrades trigger forced exits. Forced exits trigger spread spikes. Spread spikes trigger more downgrades. This isn't a crisis that announces itself. It cascades quietly, violently, and fast.
DelphX didn't set out to sell a hedge. They built a new layer of structure, one designed for this moment. CPOs protect institutional capital from rating slippage. CRNs offer yield for writing risk when you believe that downgrade won't come. It's a two-sided market built for one-sided pressure.
And the person who designed it, DelphX CEO Patrick Wood, understood that this wasn't a next cycle problem. It was this cycle, the one unfolding now. With AI-powered risk modeling, programmable payouts, and full collateralization, credit rating securities aren't just timely, they're tactical.
If you're managing risk for a desk, a fund, or a QIB portfolio, you know the problem. The real question is, do you have the tools? Visit DelphX.com, download the white paper, explore the investor deck. And if it fits your mandate, reach out. That conversation could change your 2025.
Again, that's DelphX.com. These are private placements available only to qualified institutional buyers under 4(a)(2). Not financial advice, not retail. But if you're a fit, this is structural alpha.
And if you're looking for more, this episode is part of a wider arc. Listen next to the 2025 debt crisis, what you're not being told, where we map the macro credit wall behind this entire downgrade setup. And liquidity crisis looms. Protect your money before the crash, where we expose how the plumbing breaks when risk moves faster than capital.
Both are streaming now at financefrontierai.com. Go deeper, connect the dots, see the system before it fails you.
And if you want to stay ahead of the biggest financial shifts, including the ones Wall Street isn't ready for, don't just listen. Stay engaged. Subscribe now on Apple Podcasts, Spotify, and follow us on X. Explore our full lineup: Finance Frontier AI, Make Money, and Mindset Frontier AI. Streaming now at financefrontierai.com. Already with us? Leave a 5-star review on Apple or Spotify. It helps more listeners uncover what's really moving the markets. And if you found value here, send this episode to a colleague who needs to understand the downgrade domino. Don't miss out. Sign up for our newsletter to get exclusive insights, urgent alerts, and financial intelligence delivered straight to your inbox.
Before we go, remember, the information shared in this podcast is for educational and informational purposes only. It's not financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Credit markets are volatile. Downgrades, rate shifts, and macro shocks carry real risk. Always assess your exposure, your mandates, and your margins before acting on market moves.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI copyright 2025. Unauthorized reproduction or distribution is strictly prohibited.